Hello and welcome to Noble's Virtual Equity Conference. My name is Pat McCann. I'm an analyst here at Noble. Today I have the pleasure of introducing Vishay to you guys. We have Steve Cantor and Bill Clancy. They're going to get into the presentation in a moment, but before we get started, just wanted to let you all know that you can submit questions through the Q&A box at the bottom of your screen. And at the end of the presentation, we'll get to as many of those as we can. So without further ado, let me hand the floor over to you, gentlemen.
Great, thank you, Pat. It's great to be here today to tell you about VPG. Very excited about the opportunity to tell you about our company and our strategy and what's ahead. Before we do, I do want to remind everybody we will be making forward-looking statements today, so you should read our SEC filings carefully and understand the risks associated with those statements. So to begin with, fundamentally, VPG is a sensor company. We call ourselves a sensing and precision measurement technology company. All you need to do is look around you in your cars, in your homes, in your offices, in your factories. Sensors are everywhere, and they continue to proliferate. It's a very large market. We play in niches of that where precision and performance really matter. So we are a premium product company focused on really the most demanding applications for our technologies. So we were established in 2010. We have operations around the world. We report in 3 reporting segments. And then just to point out one of the factoids on this slide, we've been growing at a 7% annual rate on a compounded basis over the last 7 years. And we think that most of that is organic. We think that actually compares pretty well with other sensor companies. We're an established partner to the Fortune 1000, many of the Fortune 1000 companies. And really our value proposition to them is really to help make their products and processes safer, smarter, and more productive. And the way we do that is we really are the first step of what's called the value data stream. For critical applications where you need that level of performance, if you don't get that first step right, in other words, the acquisition of that data, everything downstream doesn't work to spec. And we think, even though we're not an AI company, we do see that AI will require more data, and the quality of the data is going to be even more important going forward. So our solutions are helping customers in a lot of markets, as you can see in this slide. We have what we think is probably the most diversified set of markets for a sensor company our size. We have number 1 or number 2 positions in the niche markets that we address. Our relationships with our customers are very sticky. It's an engineer-to-engineer technical sale. And in many cases, our products are sole sourced. And so even though they're a small part of the bill of materials for our customers, they provide a disproportionately high value. And that contributes to our gross margin and also the consistency of our relationships with those customers. So the diversity of our markets is just one of the cornerstones which makes us a strong business. I would say the other things is represented on this slide. In the middle part of the slide, you could see our results for 2023. We're coming off the second best year in the company's history with revenues of $355 million. You can see our gross margin, operating margin, EBITDA margin here. But really, I'd say what's probably more important to you, the investor, is really what's on the right-hand side of the slide. And those are our long-term targets, 3 to 5 year targets. We're looking to grow this business in the low teens. That's a combination of both organic and inorganic. And based on that level of revenue growth, we think we can deliver the target operating metrics that we show here: 45% gross margin, 18% operating margin, and a 22% EBITDA margin. I do want to just point out, though, that in the first quarter, we achieved a record gross margin for the company of just above 43%. And so that even on a more muted sales, we were able to do that, which gives us a good degree of confidence that as our revenues grow and recover here, that these financial targets are certainly within our reach. So how do we plan to grow organically? I think it's really captured on this slide. We're a leader, as I mentioned, in the markets we serve today, but we now see larger and faster growing opportunities that are really being driven by a number of secular trends and that are really presenting us a path to accelerate our growth going forward. Those trends now are beginning to dovetail with the internal investments we've been making in our company over the last several years in terms of operational capability, in terms of R&D, in terms of also business development. And so it's really that convergence that is really the exciting part of the VPG story. So the takeaway here is really we have greater capabilities than ever before to capture larger and faster growing opportunities. This is a snapshot of the business today. We report in three business segments: sensors, weighing solutions, and measurement systems. I think of these as sensors being components, weighing solutions being modules, measurement systems being application-specific systems. And each of these segments has their own business strategy, manufacturing, R&D, go-to-market strategies, as well as margin and revenue growth profiles. The sensor segment, you can see, we reported just under $140 million in revenue last year. We think that grows long-term in the mid to high single digits with gross margins of 40% plus. The weighing solutions segment, you see here, we achieved a revenue of $122.5 million. We think that grows more like GDP plus. But the gross margin has substantially improved over the last several years and is now approaching that of sensors. And then measurement systems, we think that grows in the mid-single digits with gross margins of 50% plus. So it's really the combination and blend of these segments and sales and profit models that we believe gives VPG balanced growth, profitability, and resilience through market cycles. So what are the trends that are really driving the opportunities ahead of us? We've captured four of them here on this slide. They are electrification, industrial automation, digital transformation, and certainly in continued development of defense and space technologies. I'll just touch on these briefly in the next few slides. So electrification, certainly I don't need to tell you a lot about this. You see this in your daily lives. But the important point here I want to make is that it's not just automotive for VPG. It's bikes, aircraft, industrial equipment, and many other applications. And just to give you kind of a quick sense of what we're doing today regarding electrification, we have product that's used on certain e-bikes to help extend the range of those bikes and the battery life. We have products that are being used in the safety testing of electric vehicles, not just cars, but also eVTOLs, electric vertical and takeoff landing aircraft. And then we're involved with the testing of EV batteries during the manufacturing. Turning to the next trend, industrial automation. It's not a new trend, but it's one that we believe is accelerating. And certainly, on one hand, we have advances in artificial intelligence and connectivity that are driving investment here. But on the other hand, you have what the world experienced coming out of the pandemic, which is, we all know, are labor shortages, higher costs, supply chain issues, and increased global competition. So we think that's a great setup for increased investment globally in industrial automation technologies. So we do have significant plays already in this. We've been serving the robotics market, as you can see here on the left hand side, for many years, but we're seeing actually a new form factors of robots being developed by our customers. So not just humanoid robots, but drones and other kinds of robotics and surgical robots. And these are offering opportunities for our technology. And then on the right-hand side, we're highlighting here applications related to precision agricultural and agricultural equipment. This has been a great market for us, and we see, even though it's a bit soft right now, as farmers around the world digest the equipment they purchased over the last couple of years, we think long term this will continue to be a strong area for us. So defense and space technology, it's not really a trend, but it's something that obviously is getting more investment around the world, especially given the current conflicts and tensions that unfortunately we're seeing in some regions. This is a market that we've addressed for many years, but there's increasing number of opportunities here with new space systems. Our products are used as part of space programs to test parachutes and airlift system integrity. We have a set of very sophisticated dummies or mannequins that are used by the U.S. Air Force to develop safer equipment and vehicles to protect our soldiers. We're on missile and defense systems, and of course, we're involved with a number of drone programs, both air, land, and marine vehicles. The digital transformation, we define it as really the application and integration of digital technology into physical processes and equipment that provide enhanced value and efficiency. It's a mouthful, but it's not a new trend, but it's one that we continue to expect will grow and evolve, particularly being driven by the development of AI and machine learning. We have a number of plays in that. Currently, we're involved with semiconductor equipment, both test equipment and front-end equipment. We're on consumer electronics products, both not just electronics products, but also bicycles. We see opportunities related to data center and fiber optics equipment, and which is an area really an important, crucial area that's going to need to support some of this AI emerging applications. And then, of course, the medical prostheses is a market we've addressed for a number of years, but we see some interesting developments going on in that area. So that's sort of the external side of the convergence. I'd say the internal piece is really reflected on this slide. It's our focus on how do we drive and create value using our core competencies, such as innovation, leveraging our technical expertise, using and expanding on our proven acquisition strategy, our focus on operational excellence, our sustainability, and of course, now expanding our business development capabilities. And so all of that is really aimed at what's on the right-hand side. So if we continue to execute well and according to our plan and deliver on our long-term targets, we think that we will continue to scale and grow the business. We'll deliver above average operating leverage, and also consistent and growing cash flow. And really, that's what we think drives the ultimate value to our stockholders. We do generate a significant amount of cash flow and free cash flow. We think we have a good balance in terms of our capital allocation strategy. It begins with investing in our internal capabilities to really enable us to go after these larger and faster opportunities. We're coming off of a 4-year period where we've invested significantly to build out some new facilities, to move manufacturing to lower cost areas, to consolidate manufacturing, and to add automation. And it's really those investments that we believe have been a major contributor to our ability to achieve a record gross margin like we did in Q1. And we think that's just the foundation. So moving beyond sort of the internal investment, we see opportunities to deploy our capital with value-creating M&A. We have a successful track record of doing M&A, and we think this is a great platform. We have a solid balance.
So I think Steve may have dropped off. What he was talking about, what for value creation M&A is, we have an excellent balance sheet, unleveraged, and
I don't know what happened. I think the Zoom got disconnected. Can you hear me? I'll just keep going here. And it was at the end of the prepared remarks. Yeah. So I think we have a great business model, a strong technology, great customer relationships, and really a great setup to begin to deliver on the operating leverage potential that we see in our business. And with that, I'll turn it back to Pat for any Q&A.
Thanks, Steve. Yeah, let's get right into the Q&A. Our first question is the following. You reported continued soft demand trends in your end markets in Q1. Are you seeing signs of stabilizing demand? And when do you expect order trends to re-accelerate?
Yeah, so in the first quarter, we did see what I would kind of characterize as more muted revenue levels and order levels. I think it was sequentially down from the fourth quarter, but I would characterize those trends really around 3 factors. The first being that we do address some cyclical markets such as semiconductor equipment and steel production. And so those markets have come off their bottoms, but our expectation going into the year was that we would see those recover more robustly in the first half than they ultimately did in the first quarter. The second factor is that we do have a segment of our business which is focused on industrial markets, industrial weighing markets, and general industrial markets. And we've continued to see those be sluggish and soften a little bit. And then I would say the third factor is that in terms of the distribution channel, we sell about a third of our sales go through distribution, that the customers within that channel continue to be very cautious. And that's something that's been ongoing really since the beginning of the second half of last year. Our expectation is, though, that we do expect things to recover. We think that recovery is now more towards the end of the year, and also that recovery will be helped by the beginning of seeing some of the fruits of the investment in business development, at least the early fruits of that we think continue on into 25 and 26.
Excellent. And the next question is, you do serve a broad array of end markets. How does that diversity relate to your strategy and your business model?
Yeah, so I'd say one of the things that we do really well is we are able to take our technologies and really customize them and modify them across a broad array of markets. And we're able to do that because not only do we have what we believe is the best available technology, but we have really a cadre of very experienced engineers and sales engineers who are able to work directly with our customers, particularly OEM customers. So I'd say that ability to take this technology and really apply it across a broad array and a broadening array of markets is really one of our core strengths.
Great. And then I have a twofold question. So when it comes to the top line revenue growth expectation or targets in the low teens and the 45% gross margin target, could you talk about how much of that is, or to what extent that is assuming organic versus inorganic growth, and what needs to happen for you to achieve that target? And then maybe after that, we could talk a little bit about the M&A strategy.
Okay, Pat, no, that's an excellent question. Yeah, as it relates to our our 3 to 5 year target plans of mid-teens growth, I would say, and you saw that in the slide, we're running at a 7% CAGR for organic. So of that double-digit revenue growth, 7% would come organic, and the other 7% will come through M&A opportunities, which we'll discuss further in a little bit. But also answering on the gross margin target of 45%, as you heard in Steve's presentation, even on a muted revenue for the first quarter, we still hit 43.4%, which for us was a record. And given where we are, and with a continuation of there's organic growth when there's a more stable environment, plus the M&A, there's no doubt, and we have the confidence that we would hit that 45% gross margin target. And then more importantly, that EBITDA target of 22%, we would definitely achieve that given where at that point in time the revenues would be. If they're growing on a double digit, we would definitely hit that.
Got it. And then could we talk maybe a little bit more about M&A and what your strategy is there? How do you assess targets in the M&A space?
Sure, no, excellent question. I mean, over the last few years, VPG has been probably, I would say, even more acquisitive than we have in the past. I mean, we have 5 successful acquisitions under our belt. But yeah, and given our financial strength over the last few years, we've been given more opportunities to participate, whether it's in a bidding process, an auction process, more discussions. We've had more leads with investment bankers. And from a standpoint, we've always been very diligent. We've had 5 bolt-ons, but we're also looking for a significant one where it could be revenues in the, say, 60 to 80 million of revenues or greater, and EBITDA over 20%. So a 12 to 15 million for us, that would be a significant transaction. And we look at it from a perspective of it needs to be an internal rate of return of at least 15%. Should be accretive in the first year, and I'll have a return on investment of at least 10%. We're very disciplined in our actions and what we do. We've also, because we have an unleveraged balance sheet, we do definitely feel like we have the capacity and a desire to land a successful one. And even if we were to run our leverage ratios up above 2 or whatever, maybe 2.5 for a period of time, we know at our cash generation that we could definitely reduce that fairly quickly and obviously be a very successful acquisition and continue to grow on that path going forward.
Great. And then could you maybe add to the M&A strategy, talk about the internal investment versus the M&A versus a stock buyback,
Sure.
And kind of an update on how you balance those priorities?
No, I mean, excellent question. This is all part of our capital allocation strategy that we've laid out with senior management and with the board's approval. The organic growth, and I think Steve touched on this, over the last 4 years, we spent well over $75 million on the infrastructure. Whether it's building a brand new facility in Israel for the sensor segment, expanding our Japanese facility, increasing or adding a second floor to India. We've built that infrastructure and spent that money, all generated by our cash from operations, plowed it back in for future organic growth, and have the ability. And also, we've done further, I'd say, automation by adding more machine and automation, as opposed to, I think you heard also that during COVID, labor was tight. Therefore, automation, adding, people are going more towards robotics. We spent more money on the capital side. At the same time, now we're continuing to look for M&A opportunities and look for something that would be, either adjacent technology, new technology, similar end markets, maybe an expansion to new end markets, whether it's, preventive maintenance, whether it's data centers. It could be a host of things. And then as that's going along, also at the same time, we do have a buyback program. We're in the market every day, buying shares back. So it's a combination of those strategies that are working today for basically to benefit and to increase shareholder value.
Yeah, if I could just add one point regarding the internal investment. So, Bill described a significant amount of investment we've made in our operational capability. Obviously, that's geared towards efficiency, and also, but also as equally as important, it's enabling us to make our products in higher volumes consistently. And that's important as we think about some of these new opportunities. One that I kind of went over very quickly is related to consumer electronics. The reason why we've grown that consumer electronics business from basically 5 years ago to, somewhat, 10% around or less, around 10%, was because now we have not only the best technology, the best performing product, but we can make it in the quantities and deliver it when the customer needs it. This is a big change. It's enabled us to get into that business, and it's a page from the playbook that we are now looking to leverage in other areas.
Great, thanks for the additional color there. While we just have a couple more minutes, I wanted to touch on a couple more questions. First, I wanted to double back to the recent results. Bill, you alluded to the record margins and which did closely align with your target moving forward. Could you talk about how you were able to achieve that despite the muted sales in Q1?
Yeah, so Pat, it's a good question. It's our gross margin, it was a record. I mean, we were coming off a record in the fourth quarter of 2023, and then even with more muted revenues, we still saw a gross record a record for gross margin. Part of that is what we talked about, more automation. We've added more automation, better yields, better control of the cost. We constantly go through cost reduction programs where we're constantly, whether we're merging facilities or combining them to reduce them. And then we also, a part of it was, there was a favorable product mix. The fact that we had, an increase in our measurement systems segment, where the gross margins are well in excess of 55%. That also helps as well. So when you add all those combination factors, and given the profile where we are today, we feel quite confident we can maintain, given that the same or similar product mix, similar gross margins as well.
Excellent. Then maybe one final wrap-up question, sort of a general question. Could you tell us a little bit about what you think investors don't understand about the story, about the company?
Well, I'd say I have a list. Maybe Bill has a little bit different list, but I would say what we continually run up against, investors who may have looked at this company 5 years or earlier don't appreciate the change in strategy, the focus on growth, and as well as the investments that we've just described. So I'd say they don't quite understand where the company is today versus where it was, say, 10 years ago.
And Pat, I would add also, I mean, given where we are today, I mean, we are in such an excellent position that when the market will come back, when it does come back and we're stable, we are geared and set to generate even more significance for us. Every incremental dollar of revenue, 40% goes to the operating margin. And there's that significant operating leverage that we've been talking about that will come to fruition. And this is how we're going to hit our 3 to 5 year targets as well.
Excellent. Well, it sounds like an exciting time for the company looking ahead for the next few years. Gentlemen, thank you so much for being here today. Really appreciate having you.
Thank you.
I appreciate it. Thank you very much for having us.